Thank you so much. My questions are not in this order. So I think warm welcome to all of you for this 17th Realty Plus Conclave, Excellence Awards West. I think the topic is very interesting and rightly so. India is at that inflection point. Real estate investment pulse, what's fueling capital in India. I think over the last 8 years, I mean, Nitin will throw a lot more numbers at us slightly shortly, but I think $55 to $60 billion in the last 7 to 8 years is the capital that has hit real estate sector. And I think from a point where pre-COVID, where the markets were to where it has reached now, at all-time historical highs on most of the sectors. Office is doing well, residential is staged a historical comeback, and alternatives are like data centers and student housing, everything is seeing light under the sun. While we've seen a lot of capital inflows over the last 2 decades, I think, and in the last decade more so from global funds, what is interesting is the amount of domestic capital that is hitting the real estate sector. I think I'm sure you all want to listen to the speakers, so I'll just bring in the first theme on the color and nature of capital. Nitin, I'll bring you in first. You know, there are a lot of sources of capital available to the real estate sector today, right? Global, domestic, debt, equity, structured. What kind of structures are becoming more acceptable in today's context for both developers and investors? And also, there's a lot of activity in the public markets, right? REITs and IPOs. So can you throw some light on that for the audience?
So when it comes to real estate capital, I think there is a lot more available today than there ever was. And all kinds of capital, right? I mean, capital, different kinds of capital gets attracted to different kinds of risk. So it really depends on the kind of risk that we are talking about to determine what kind of capital it'll attract. And you can cut that in so many ways, but let me try and do this maybe just by, very simply, there are 2 kinds of risks according to me. One is at the asset level itself. And there, a lot weighs in on that. Real estate is about location. So is this a mature location? Is it an emerging location? Then at what stage of the project life cycle are we talking about investing? Is it at land stage? Is it at approval stage? Is it at development stage? Is it a ready asset? And the third differentiator at the project level really is that whether is this an annuity asset or is it an asset that you're building to actually sell? And somehow we've seen some of the larger investors, Ankur, you can correct me if I'm wrong, but they've been able to wrap their head around an annuity asset a lot better than they have been able to do it with, a build to sell, which is largely just residential. Because the perception of risk in residential from an investor's point of view is still very, very high compared to annuity assets. So one kind of risk really is the kind of project we're talking about. And the second sort of way to cut risk really is in terms of who's the developer who you're funding. Now, this was always really important, right? Because you need a good partner in real estate, but I think it's become even more so a key criteria for investors to decide what kind of capital and at what cost. Now, within the who's the developer question, you have your tiering, right? So you have your stronger brands which are able to sell better, acquire better, have got a balance sheet that is a lot more stronger. Not only is the availability of capital far better for the stronger brands, it also comes at a much lower cost of capital. And in my mind, that differential between a tier 1 and a tier 2 developer now has become extremely large, so much so that it has become a moat in itself. Because these larger developers have the luxury now of going out there and attracting this capital, any kind of capital, debt, equity, structured, there are guys on this panel who know debt and structured more than me, but if I was to just talk about equity, in the last 2.5 years, I think we've raised close to about 55,000 crore rupees of equity in the capital markets for the real estate sector. And when I say real estate sector, I am clubbing your residential, office, retail, hotel, flex space, and the like, right? But still, 55,000 crores of monies has been raised. Out of that, 20,000 crores probably is just residential, follow-on offerings from existing listed developers. Which is why I see that this differential of being able to go out there and raise equity is what is luring so many developers today to sit up and ask the question, can I list my company too? And as bankers, we are extremely busy today just answering that question for the maximum number of prospective clients that I've ever seen. And that's really what's keeping me most busy. So you have the capital markets, which have got today a lot of depth, are attracting investors, institutional, as well as family office and HNIs. Now, a country of Indians who love real estate really is in your blood. If you do a top-down sort of maths in terms of how much money goes into real estate, it's humongous, right? I mean, we are a $4 trillion economy. Even if I take a savings rate of 25%, which is lower, it's actually higher than 30%. But even if you take 25%, that's, $1 trillion worth of savings, of which at least half goes into physical assets. And again, I'm being conservative, that number's pretty high. And so out of $500 billion, probably 50%, if not, actually it's closer to 70, but even if you take 50 or 60%, you're talking about $250 to $300 billion worth of money going into real estate in India every year. And this is supposed to hit, $1 trillion by 2030. So there is enough money and more. It is just a question of whether there is enough of money for a particular developer or a particular project. And that's where the tiering actually sort of happens.
Oh, that's a lot of capital, by the way, but taking that as a segue, I'll bring you in, Ankur. While India is large and pretty large by the numbers that we talk about compared to Asian capital, and Hines, of course, you're one of the largest global investors, developers, and asset managers. Barring the first wave of global financial crisis, most of them have been broadly successful in India. But when you compare India to other Asian markets, where do we stack up? And what does India need to do to attract long-term capital? And what are the concerns that are holding back allocation decisions?
Thanks, Vamshi. You made a very careful caveat over there about institutional investors who have survived post the GFC. What I should add is that out of the 100 investors which were there pre-GFC, probably only 5 or 10 exist. And these are the guys who have buckled down and have had the tenacity to go through whatever investors have had to go through. And I think, the 90 investors who burned their fingers, it's still scar tissues for us. I'm sure for Nitin, I'm sure for Amit, as we look to raise capital and, as we look to bring more institutional investors into the country. Look, for meeting the real estate capital needs in a structural way for the long term, you need institutional capital. There is no two ways about it. And yes, in the last 10 to 15 years, the institutional investors who've been there have experienced India, have got good returns, and hopefully this becomes a gateway for more and more capital to come in. Coming to your question about how India is stacked up against other APAC countries, look, forget APAC, I would say compared to the world, we are a shining beacon in so many ways. There are obviously a lot of macro tailwinds, and we could spend the next hour just talking about macro factors for India, but I'll just touch upon a few more important ones. GDP growth, we have been in the top, we've been a top growth market for a long time, and data suggests that for the next 15 to 20 years, we'll continue to be amongst the top 3 growth markets in the world. domestic consumption. Nitin spoke about it in terms of savings and money moving into hard assets, but consumption, we're not as dependent as other countries on incoming, on exports or other sectors. Our working age population is amongst the highest, and if you actually look at a 10-year trend, APAC ex-India would actually have negative growth in the working age population. And we are the only country who's actually taking that number to a positive territory. So there are lots of tailwinds, and one of the most important tailwinds in my view has been the stable government and the policy reforms that we've seen. Be it GST, be it RERA, the bankruptcy code. I think all of these have been, and this has led to our rankings in the transparency index going up. And all of these makes a big difference when a new investor or a capital source is looking at India at a macro level. So, very strong macro tailwinds compared to APAC. Coming to sectoral, tailwinds or what makes India stand out. If you look at housing, for example, we are going to have more than 350 million Indians going to come into the urban, the urbanization theme that's playing out. More than 300 million people are going to move to urban cities in the next 25 to 30 years. Imagine the demand for housing because of these urban consumers. The average household size in India, which used to be fairly large earlier, is structurally reducing over, there's a structural downward trend. So that means even more houses. So there is going to be clearly demand for housing. Office. India is probably one of the lowest per capita office consumers in the world. Our capital values are the lowest. Our rents are the lowest. Tier 2 markets are still largely unorganized and untapped. So, there is no dearth of demand. So these are some of the reasons why India stands out and will continue to do well. In fact, India probably accounts for more than 60% of APAC level leasing. And that is something to, really take note of. Coming to what can be better and what is holding capital back, I think execution risks and the approval risks and the government-related risks are still very high. We are an investor and an operator ourselves, not as good as some of the other colleagues that I have on the table here, on the panel here, but between a municipal corporation rule change, between a state law changing, between a central law changing, and if something gets left over, then the judiciary coming and imposing something. And even after that, if something gets left over, then someone like an NGT comes and puts a ban, and you don't know what to do. So I think those risks are big deterrents for somebody to think long-term investing in the country. I also think liquidity in our market can be better. Yes, we have 5 REITs, but there are probably 10 more REITs which can come up. We need to see more logistics REITs. We need to see more retail REITs. I think purely speaking as an investor, that would give one more comfort. So yeah, that's a few points.
I think I was there at a online event on Asia Pacific, and one statement stuck with me: you cannot ignore India despite all the risks that India poses. But one interesting statement there was about the yield to interest rate negative spread, which is not there in any other Asian markets. So that is one thing that people keep saying holds back institutional capital or global capital. I'll bring you in, Amit, here. I think you have been driving the domestic capital story to a large extent. Of course, you have now capital raised from institutional global players also. You've been working on different platforms to finance real estate. What's the larger play for Indian developers, right, in this, and what's the way forward? Is domestic capital, is domestic institutional capital, pension funds, insurance money, HNI, family offices, are they stepping up meaningfully? And will they fill in and capitalize on the opportunity, or it will still be largely dependent on global capital?
Thank you very much, Vamshi, and my friends have already spoken a little about capital inflows. And thanks to Nitin, there's too much money in domestic markets for real estate. He's been doing a great job of selling real estate to to family households and SIPs, which is amazing. They've stayed away from real estate for a very long time, so I'm happy to see public money come back to the sector. Of course, Ankur is doing a phenomenal job of getting global capital to commercial real estate and now other asset classes. But now let me put everything in context. So first of all, I think there are tailwinds for India as a macro story, but headwinds when it comes to the US policies, the entire geopolitical environment, and people being cautiously optimistic, which has reflected also in the H1 FDI inflows or total institutional inflows. Typically, where we saw close to $4.5 billion, the first half only saw $3 billion, of which the foreign institutional contribution has fallen by over 40%, which typically has been 60-65% of the total contribution pie, today stands at close to 50%, which has been made up by the balanced domestic institutional investments. So increasingly, our reliance and resilience will come from domestic capital. Whatever be the macro story for India, nobody's going to come in a hurry. I think there are enough opportunities globally for special situations, for growth opportunities, etc., at scale. Finding opportunities in India at scale is a big challenge. I mean, we saw that the total market cap of all the REITs put together would be what, $10-12 billion, and we had $15 billion, and one REIT in the UAE comes with $8 billion. So the scale is a challenge, So if I have to put large sums of money, and if I have a $500 billion or a $300 billion fund, I need to put out at least $5, $10, $15, $20 billion in one geography for it to be meaningful. So I see that as a constraint, and therefore domestic capital becomes even more relevant. If you can bring in the way SIPs have brought in money. Now we were, like you mentioned, APAC, and we were in London, and they said, why do you need money when you have $3 billion of SIP money coming into capital markets every month? You have $36 to $40 billion of equity money coming into your markets. Where do you need foreign money? But that is not available for real estate because it is not democratized to that extent. We have maybe a REITs, maybe we have a few public issues. To that extent, there is some participatory interest, but it is only limited to that. We still need to open up the gamut of opportunities much larger for the overall demographic engagement with the sector. So to that extent, yes, there is no dearth of capital provided we can open it up. Barring that, there will be a dearth. For certain people, for certain opportunities, for certain asset classes which are emerging, capital will be constrained. We need close to 6 lakh crore rupees of developmental capital over the next couple of years alone. We don't have that money readily available with all of us put together, which means there will be a deficit. It will go to the more capable players, and the other players will suffer, or they will have to find alternate means to make do. So that is a real challenge. And foreign money is not coming to fill that gap either. I mean, they're chasing yielding assets. And again, you mentioned the right problem. There is a gap or a delta or a spread, negative spread. I mean, who wants to play a negative spread game in a country which is then only based on cap gains or upside appreciation, which we don't know in the current rental environment where there is a headroom for rental growth. Maybe there is, maybe there is not. It's already seen a significant uptick. Now, we have seen a significant amount of interest in residential, which is very heartwarming. So far, residential has not seen global capital. It's been largely for the purpose of stable renting, core plus. But fortunately, last year, 45% of the money went to resi, which is great. We saw a recent announcement where HDFC announced that $1.5 billion has got committed by a multilateral organization in a $5 billion resi fund, which is phenomenal. So I think the core demand driver of real estate being resi at 80-82%, being able to draw global capital is amazing, because that capital is likely to stay and get redeployed for a longer period of time, right? So I think, and it is far more therefore spread out across players. It is not going to 6 CRE developers. It's going to potentially 600 players in the country, which is great because then the penetration of capital is greater. And therefore domestic capital engagement is getting larger. As we know, he runs an AIF, I run an AIF, he runs an AIF. AIF is today becoming another largest source of domestic money. Almost 43% of all credit funds raised and mopped up are going to RE. 15% of all AIF, debt equity combined, largest sectoral allocation is still RE, which is fantastic, right? 74,000 crores of capital within AIFs coming to RE, which means that this is a sticky asset class where money is getting raised, and even if people are raising a credit fund without putting money in real estate, they cannot get the yields, right? They will still be in a and therefore they cannot meet the promises to domestic LPs. So I think that is great. The constraints of raising domestic capital are several, which is more structural, not liquidity but structural. There is a caveat for now banks to invest into AIFs, which our friend has struggled for 1 year, found a temporary solution and fix, and started to reinvest. So the government itself is axing its own toe, saying I started a $2 billion fund, but I want to not allow banks to invest anymore. So there are these flip-flops which are a problem. And by the way, now there are no other DFIs which are willing to come forth, who've only been allowed to invest into REITs in a specific way. That's it. So they cannot come into AIFs, they cannot come into any other structure largely. So the DFI participation itself is a problem, which means now you have to finally end up depending upon HNIs. So that's a very small segment of capital in the country. It's a very small segment. So that it becomes, so while India has the potential to raise money, India is the only option honestly for developers and real estate to raise money with foreign capital withdrawing. But unless we open up our regulatory frameworks to allow larger and broader participation of capital, we will struggle with a capital deficit. So while Nitin has a lot of money for a few people, but large number of people are still struggling for money because they are not qualifying on several counts.
Yeah, that's a great point. And sorry, Nitin, you want to say something?
No, just to add to what you're saying, and I kind of agree with you, but just a pointer in terms of this domestic capital and how it's really stepped up, right? And I'll take the REITs as an example. The first REIT product, not well understood, as always it happens, right? It's a new product. The first REIT, 90% money in the IPO, foreign. Domestic, 10. The last REIT, 95% of the capital, domestic. Foreign, 5. And out of that, 44% was HNI money. So that's how you've seen domestic capital really step up. Now, I agree with you on another point that you said, that the structure needs to change, because when you present even HNIs with a well-structured and understood product, they are more than willing to invest. Unfortunately, in residential, right, and the smaller developers and tier 2, I don't think the product has been put together in a structured manner for them to wrap their heads around. And once we get that right, you will see even them being able to access this very deep pool of capital.
I think great points, yeah. And I think all's good now, right? And investors are seeing their funds being utilized well. There is capital, there is return on capital, and expectations are better now. And the markets are strong, so the deliveries are happening. But all was not well a few years back. And Shuvam, I have to bring you in here, right? It was a much needed intervention and impetus to the sector a few years back, right? It probably pushed the real estate sector in the right direction, at least leaving the larger, like you said, that small pool aside, the larger network of the real estate ecosystem. What is the role of such capital now, now that it's out of the woods? And do you need India, do you believe India needs a permanent mechanism for last mile financing?
Right, thanks. So I'll start off with an analogy first, right? So if you see healthcare, right? The average life expectancy has increased, let's say from 33 to let's say 63 now, right? But have you ever seen an ICU of a hospital empty, right? No, right? So I would classify SWAMIH fund or any such structure, right, as an ICU, that way, right? So I'll go back in time, 2019, when SWAMIH fund was conceptualized, the number of stalled housing units in the industry was pegged at 4.6 lakh stalled units. So SWAMIH came in as a meaningful intervention, but the beginning of this year, we had completed around 50,000 units, and we are on course to complete around 90,000 units, right? But where are we today? So as per the last prop equity report of 2024 end, the number of stalled units, it's still 5 lakh units. So it's hovering at the same figure, right? So what it means is, because the nature of the industry is such there will be many projects and many developers will fall behind the curve because of host of reasons. And for those reasons, we'll need to have a separate session altogether, right? But because of these reasons, I don't think, be it SWAMIH or be it any such platform for last mile financing, especially for providing relief to home buyers, it cannot be a stopgap arrangement. It has to be systemic. It has to be institutionalized, right? And I think seeing the pivotal role played by SWAMIH, government also realized this. In Union Budget 2025, they have announced SWAMIH 2, right? So while it's still in the cards, in the planning phase, I think the stakeholders have also realized that. The industry has also realized that. So this mechanism or this need will remain till the industry kind of changes structurally.
But then you're a social impact fund.
Right.
You're not a for-profit. And
Right.
that is why only the government can plug that problem. I don't think private capital, either in India or foreign, can solve for that. I mean, we run a special situations fund,
Right,
and trust
right.
me, finding good last mile projects is impossible today.
Right, agreed.
Whatever had to be solved is solved, and whatever has not been solved cannot be solved.
So that's what the problem we are solving. I agree that the normal normal market forces may not be able to help, but we are together working on few of projects together, right? So you are getting your return, I am getting my return, and I am getting my social capital or social impact getting created. So I agree we need to participate. I agree that only maybe a government or a public stakeholder or someone from a social impact initiative can look at this part of the piece of the jigsaw puzzle and kind of bring that intervention in place.
I think it's a much needed, I think like you said, it's social impact and not many people can step in and work at that cost of capital. But that said, I think the crux of this whole conversation is...
No, but I think, I would request Reality Plus to one day call the entire SWAMIH team and felicitate them. I mean, I am not kidding you.
Yeah.
I am not kidding you.
I agree.
The kind of work, and he alluded to the work we do together, the kind of work, the kind of effort. How many? 200 projects?
Yeah, funded project would be 135.
135 funded projects, boss. I mean, and the kind of people that they're dealing with, the pressure to turn it around and give people their homes is absolutely extraordinary. And I think it is important to understand how capital, not just capital, but the engagement of capital to solve that problem, understand it and solve it, can create such a massive delta. So I really would compliment Shuvam and SWAMIH for what they're doing.
Thanks for the kind words.
And one more word for that, and they've very hawkishly managed that capital. Where is it going? Who is doing what with it? And we've been involved in our own little way. But I think, like I said, the crux of all this is the developers, right? They are the ones who are building. Capital wants its return. Home buyers or occupiers want their spaces, but developers are the ones who are building, who are facing the brunt of everything, right? Everybody wants things from them. I'll just bring you, Mahindra. So, how has been the access to capital for developers, and what challenges do you face? Everybody is a fair weather friend, but what happens when things don't go well? And how have your conversations with investors evolved over the years?
Okay. Good afternoon, everyone. It's wonderful to be a suitor, right? I'm the only developer here on this panel, and everybody has a lot of money, so which is actually a good position to be in. Firstly, so thank you. But I totally agree with what everybody spoke. I think there's a lot of money, there's a lot of liquidity available. But yes, partly what Amit said. There are a lot of capital is chasing very few players, and not necessarily everybody who needs money. But to a very large extent, and very candidly speaking, I think the people who provide capital are also to be blamed, because sometimes, from a developer perspective, if I say that I want probably 1,000 crores and go to a particular player, and obviously, no, but it's not an NGO, right? Everybody is here to make money. As developer wants to make money, so does a private equity investor or anybody else. Sometimes the conditions which are provided are actually not very friendly, let me put it this way. The structures are seemingly equity, but it's quasi-equity. In a sense, you want guaranteed coupons, which a lot of the people are doing, a lot of the funds are doing. And that is probably one of the hindrance, especially for a tier 2 developer. I mean, as far as, say, a tier 1 developer is concerned, they already have a lot of access to capital, both domestic and international. And I totally validate with what Amit also said. I think in last 2 years, a lot of the capital has come into reality business, and especially the residential sector. Earlier, it was all chasing the commercial data centers. Warehousing obviously has been the pull. But in residential, specifically, what we have got now is amazing. And 2 regions specifically, one is from Japan and one is the other is from GCC. And that's a lot of patient capital. That's what is needed. So a lot of money chasing tier 1 developers, unfortunately, who may not really need a lot of the capital. You know, somebody like us at Mahindra Lifespaces, you know, we're a zero debt company. We have a parent who is very strong, who is having enough and more liquidity available, you know, for us to tap into, or the intercompany borrowings or intercompany deposits that we can go and take. So for us, it's a very different thing. The cost of capital is coming down significantly. I think for the listed players, for the corporate players, the cost of capital has come down significantly. Gone are the days when, you know, people used to talk about 12%, 13%, 14%. Now, you'll be surprised, you know, the rates have come down as low to 8% or sub 8%, even on a pure debt. And commercial papers are even lower if you're looking to bridge the gap. But essentially, what I have seen as a developer, you know, for any investor, what they're looking at is obviously, other than all the financial metrics, financial parameters, is the governance factor, which I guess nobody touched upon here, but that's understood. A lot of the foreign capital that comes in is very hawkish on the governance, is very hawkish on the transparency that you bring to the table. And that is the reason, and that is where I think there's a lot of work that Indian developers, which even may be listed, but say promoter-driven companies, but listed, still have a long way to go. Because unfortunately, for varied reasons, not everybody is very, very transparent. You know, it's not very easy to, you know, open the books completely. And that's where the corporate developers who are listed, you know, somebody like a Mahindra Lifespaces or other names that you're well aware of, I think are able to get let me say, are spoiled for choice, because I think there's a lot of capital chasing us, and then we are in a good situation to be in. They spoke about the market, and I guess the market is very, very robust. Just before this session I was speaking, I said it's you know, last 4 years, you know, touch wood have been wonderful. The hope is that another 4 years will continue to be great, and then we'll figure out post that. But so far, so good. You know, we are all lucky to be in this particular era. I have not seen that. I'm not a traditional reality guy. I was in banking for 14 years on the other side. And then last 10 years, I've been on the reality side. I guess the last 5 years kind of defy what I saw in prior to that, you know, 20 years prior to the last 5 years. So all in all, a good time. And I think in all this, the only positive or the biggest positive that I see is the Indian market is really maturing. A lot of negative noise or news you must have heard, the tariffs and other things. Fundamentally, the beauty about an Indian economy is 75% of it is consumed domestically, internally. So to that extent, it will remain to be very robust. And I'll just leave one statistics with you to think. Last year, we sold around 5 lakh homes, you know, the top 8 cities. And we all clapped, right? Everybody clapped, everybody made money, the developers made money, the investors made money. China does 1 crore home a year. And this is when, you know, they are in a rough phase. And we say, you know, China is not doing well. And they still do 1 crore homes a year. So that's the kind of leap we need to make as an economy, as a country. And I think the future is all very bright. So I'll leave it at that.
Yeah, I think that's a good dovetail into my question to Srini. I think you touched upon 2 things, the cyclicality of the real estate sector and the discipline and governance and compliances the investors demand. Now, Srini, I want to bring you in here. You've been, of course, been on the developer side for a long, long time, right? And what are the investors expecting now, right? Are they asking for more discipline, deeper visibility into execution, or are they more focused on exit timelines and monetization?
So, good afternoon, all of you. First of all, I think happy to be in this panel. We have spoken about money availability, we have spoken about returns, but there is a journey between the money that is getting put and when the investor is able to exit with whatever Excel sheet projected IRRs or whatever, right? So today, the biggest requirement is, let us look at it from a developer's perspective. He is sitting at the top and he's all alone. He's all alone there. For a project, if you have to put some numbers to it, he has to deal with at least 500 to 600 touch points from him to start acquiring the land and completing and handing over to customers, right? What is he good at? He is very good at identifying land, conceptualizing a product and getting approvals. After that, he gets bored. It's like that shopping, window shopping, dekha, acha laga, Gucci ka bag hai, le lo, uske baad, how much you use is something which is not really known. That is where it is very important that there is a complete transparency to bring in from that approval stage till the handover stage. And that's the only way for anybody to make money, whether it's an investor or whether it's the developer or whether it's the consumer or an investor who has invested in a property. So from an investment point of view, even today, even if I invest a lakh of rupees, I want to ensure that the end use of that lakh is exactly where it has to be. And that is where a lot of work has to be done. And that is something which every investor will look at. Today, a lot of money is available for listed companies and grade A kind of developers. The grade B kind of developers need to up. It's not that they are not able to do it, nor it's not their ability or something. It is just that we need to give a pep to these guys where there is a lot of transparency, projects gets completed on time, and that is the expectation of an investor. I don't want to be repaid by someone else giving me the money. I want to get repaid from the project the way I had anticipated that this project would get completed in 3 years and 3 saal mein mere ko project mera khatam ho jata. Adding to what SWAMIH fund does, SWAMIH will always be needed. Our business is cyclical. 5 saal acha tha, we have seen from 2011 to 14, a great time. 2014 to 19, we all struggled. Sales were not happening, prices upar jane ka to chhod do, right? We will always see those kind of cycles. The second thing is what is to be learned from SWAMIH fund is project first. Forget how much profit they are making or not making them. It is this monthly interest coupon, what he mentioned, that kills. Because before the month starts, you are already at the month end. To accumulate money, and you accumulate money the last 15 days only for the interest and the principal to be repaid. So you are working on the project only for 10-15 days. After payment, you are rejoicing for 5 days, 10 days of work, and then you are again working for the banks to repay. So some kind of flexible capital is very, very important. For flexible capital, governance is the most important, because since you are not seeing money on a monthly basis or on a periodic basis, you need to understand, and that's what you said, the hawk's eye, right? SWAMIHs will need a lot of Hawkeye agencies which actually does this. So in my opinion, the most important thing for them is the project to get over on time and as scheduled for them to get their returns.
Yeah, whether it's an Excel sheet or a project in live, if it gets delayed, the IRRs fall. So anyways, that's I think a good round on the color of capital. I'll just now get the sectors in. We talk a lot of residential and commercial. I don't know how good we are on time. Just go with the flow. No, beyond residential and commercial. Amit, I want to bring you in here. Logistics, retail, a bit of hospitality is gaining traction. We see some action in some of the other sectors, but largely capital revolves around predominantly residential development and commercial. Both operational and income generating and development assets. How do you expect these sectors to capitalize further, and will exit options like IPOs and REITs give other developers who don't have that access and give their investors enough avenues to exit?
So the challenge is the challenge is that there is no legacy of new assets, new asset classes. So effectively you're betting on certain demand drivers. without having any history of what works and what doesn't work and who can operate it. So I was speaking to one of our friends and he said it's no longer a opco-propco play, it's an enterprise play. I can no longer sit as a data center owner and say I am only going to earn yield. I have to now earn EBITDA. So it's no longer, so it's now an operating asset class, like a hospitality or a healthcare or a hospital or whatever, right? Now, because it's an operating asset class, do we have operators to make it work is the moot question. In terms of demand, demand is humongous. When you talk about senior citizen housing, we're talking of potentially 20% of India's population qualifying in to stay in senior citizen housing. That's a very large number. It's a very large number, right? We're talking of. We don't have even 4% of that available today, of the total demand of that 20% population, which means there is 96% of senior housing which is yet to be built and operated. And there are people getting into it over a period of time, which means that it is a startup ecosystem. It will have to be funded as a startup by promoter capital, bootstrap, and a use case developed for institutional capital to come in. So I am speaking to one of the largest GCC developers stroke investors. He's saying, I love student housing and I love senior housing. Tell me how I can do 100,000 homes or 500,000 beds. I said, I don't know. Because unless I can do 500,000 beds, I can't really go and scale it. Now, that is the problem, right? Is that there is great opportunity, but it will happen in packets. It will happen modularly. Okay, it will not happen overnight. It took us, I remember starting looking at warehousing in 2006-07. It's taken us almost 15-16 years for it to become mainstream, where almost 23% of entire capital inflows are going to logistics and warehousing. 28% has now gone to commercial. Commercial is seeing a bit of a downward pressure. Absorption numbers are amazing. But new capital formation is becoming a bit cautious, given the total footprint which is getting established and the pressure on increasing rents, right? So, of course, Bangalore, Mumbai, NCR, favorite markets for commercial. So, there is obviously a need for developers of very large capabilities like Vimalendra to say, now can I try? I have built a huge industrial city. That was a startup ecosystem effectively. And it took 10 years for it to become mainstream, whether in Chennai or Jaipur and now in other locations of the country. So you need somebody of that industrial size and scale to be able to say, I am going to now create the new asset class, whether student housing or, senior living or, co-working or whatever. I mean, unfortunately, co-working is getting listed. Power to those guys, man. I mean, they were bootstrapped for so long. It's amazing. It's becoming institutional, thanks to a friend here. Right? So it's amazing. So I think things come of age. It takes time. There is potential. We are putting our capital behind them for sure, but we will have to demonstrate the operatability of those asset classes. Potential exists.
No, I think that's great. I think stay put, keep investing, keep building, and at some point the capital will start chasing you. I mean, that's probably the way to look at it. Vimalendra, from your perspective, I know I'll just bring you back to residential. Everything about residential now is premium, bridge to luxury and luxury. Suddenly affordable is not so affordable anymore, right? And, what are the models needed to cater to these two ends of the market, right? What measures are required for capital to chase affordable sector?
Yeah, no, it's a great conundrum to have, because the biggest market in terms of volume is affordable, unfortunately, right? In the Indian context. But that's a segment where, as a developer, we just don't make money. Frankly, Mahindra had a brand, Mahindra Happiness Developers Limited, and we tried to do affordable, and we have publicly called out that we will exit affordable, like many other players across the country. The reason being, you just can't have an affordable housing which is, say, 3 hours from the city center. Because, the guy can't stay 3 hours away and then travel to work. Unfortunately, the way the country is structured, your employment locations are pretty much at the center of the cities. it's just not going to work out. And we took a leap of faith like many others, and we did projects which were say 2.5 hours away from the work locations, and it's just not feasible. Why 2.5 hours away from the work location? Because that's where you'll get cheap land and you'll be able to construct. Now, in today's scenario, if you look at Mumbai, if you look at NCR, and we're just speaking about the prices in Gurgaon, prices in Noida, prices in Ghaziabad, right? Where is the land? Where is the cheap land? Let me put it that way. In Mumbai, there is no land. But wherever there is land available, where is the cheap land available? If your biggest raw material is not available at a reasonable price, you just can't make the economics work. You can, do anything that you want. You can, we have tried various combinations. It just doesn't work. The cost of construction, that's a reality. Unfortunately, it's hitting us. Development may look very easy, but it's actually a very, very complex business. When I tell my friends, the banking days were much more better because I used to sleep because everything was black and white. Here, everything is gray. I mean, very, very little black and white. Right? Because, anything can happen. The commodity pricing can change. The steel prices can shoot up in a couple of months. The latest is the labor rates. Now, you go to anybody and ask, what is the labor rate? It's just gone over the roof. And how much can you plan into a business case? And that's what they were telling, that, how do you deliver probably a commitment that you have made to an investor? It's actually very, very difficult. It's always very, very dynamic. So unless actually government comes in as a partner and they say, hey, the land that I have, I'll give it free of cost if they really want to make affordable housing work. There's a lot of BPT land available, right? They can simply come and say, hey, this is the 50% of this is for affordable housing. It's a 99-year lease, if not outright sale. We are your partners, go ahead and develop. Yes, probably that is the only model which is going to work. Otherwise, unfortunately, Vamshi, affordable is going to be a challenge. I don't see it changing anytime soon.
I'll just add one limited point. Fully agree with him. I think for a developer, the amount of risks he carries in the development cycle, the margins in affordable are just not there to justify carrying all those risks. So without the government intervention and the government support, it's impossible to cater to this segment. It doesn't need to be, in my view, 3 hours from the city. Affordable could be very much within the city as well. But without the margins, the risk profile doesn't justify. And that's true for developers or any investor looking to back a developer.
Just to add one small data point to supplement that, and of course, I think these are fundamental supply side issues we are addressing. So Vimalendra is talking of a supply side issue, and you also talked about a supply side issue, that can I supply affordable homes given the constraints? But the problem is not just supply side, it is also demand side. In the heart of Bangalore, I have sold out everything except 1 BHKs. I have 2 projects. One is a 1.5 BHK, 600 square feet. I have the other one which is 2,000 square feet. 1.5 BHK ready apartments, no sales, under construction, fully sold. The demographic dividend has changed massively in favor of more luxury products. So people who have prided themselves that hum to like happiness and several others, that we will do it no matter what, desh ki seva karenge, profit baad mein aayega, have also given up because demand itself has mellowed significantly. And I think that is a larger fundamental paradigm which one needs to be aware of, that what is the consumer really wanting, what is their ability to pay, including in the heart of the city. So when you talk of SRA development, Mumbai can provide all cost points. You can develop BDD Chawl, you can develop SRA, you can develop Dharavi, you can sell the same product for 28-30,000 square feet and the same product in the vicinity, not same product, in the vicinity for 70,000 bucks a square feet also. But the demand for that small unit does not exist.
So Amit,
that's my experience.
So Amit, I mean, you're right. City ke andar I give a 1 BHK and charge the same price, including full land and thing. नहीं होगा, उससे अच्छा I'll say 10 लाख ज़्यादा डाल के और एक रूम ले लेता हूँ, right? But I completely agree कि raw material cost ही अगर इतना ज़्यादा है, तो how is it possible for us to really participate in the I mean, affordable housing. Affordable पहली बात तो defined नहीं है. So right from there are a lot of structural things that we need to resolve on that. I mean, like we have an RG, right? There are reserved plots. We could have reserved plots in which you need to do this. So I'm sure that everything, as you rightly said, Amit, everything will evolve, and this will also have to evolve because people need homes. Roti, kapda, makan is 3 basic needs that anyone needs. So ये सब evolve होगा. I think we are in great times. We should enjoy these times. क्योंकि 5 साल के बाद क्या होगा real estate पे we really don't know. There is a lot of money. Keep the head over the shoulder and let us concentrate on delivering. I think that is something which will take us to the next level is what.
Just one point to Amit, what you said, and I'll share my experience, not that it is maybe universally applicable. I think on the contrary, if we are able to solve the supply side, there is a huge demand for affordable. Of course, we can't define affordable if it is 75 lakhs. We can't say, center of the city 75 lakhs. Then obviously, where the income levels per household is still 7.5 lakhs per year, they'll not be able to afford. But if we can provide a home which is sub 40 lakhs, say in Shivri, say in the mill land, which is no more existing in the BPT area, right? Then you will see tons of people coming. I'll give you an example where we launched a project in Kalyan, which is say roughly 1 hour, 15 minutes, 1.5 hours from say BKC effectively. We had 1,400 apartments which we launched. And in 1 month, and they were all sub 35 lakhs. In 1 month, we sold 1,100 apartments. And to my mind, I think that is a demand which is there. Unfortunately, none of us are able to cater to that demand.
And I think affordable is a touchy topic. I think I shouldn't have brought it into this conversation. Our time's gone. But I'll just take 2 minutes. I know time's up, but I just need 2 bits from all 3 of you, right? I think sorry, I'll just get you. He alluded to senior housing, and that's what I want to bring you in, Shuvam. And quick two sentence answers, please. But would SWAMIH be able to really support on the senior housing play?
See, I completely agree with, I think Amit said that, right? That this senior housing or rental housing is currently, you have to treat it like a startup, right? So SWAMIH is more brownfield, it will come at a later stage, right? So let the sector develop. Maybe the government can create incentives, right? Like we spoke about affordable, right? Stamp duty. For example, today RBI had a specific risk classification for residential housing, right? Similarly, you can have something for affordable housing. Land you can reserve. Today you have, R zone, commercial zone, but you do not have something for affordable, right? If the raw material, I think you made that point. So raw material has to come cheap. It cannot be only you reduce the size. So you see projects where the sale unit is smaller than the rehab unit, right? So that is not affordable, right? So all those things have to come in together, and then only these so-called sunrise sectors can come up.
He will come in a matured one. Atak gaya to main aata hu bhai.
Sorry, very quickly. Ankur, student housing, senior living, would those entice you or interest you, or any of these sectors outside of the usual ones?
Look, there is opportunity in every sector in India. I think everybody agrees that execution is key. I think these need more scale. For institutional capital to come in, we need to see scale, we need to see operators. Srini spoke about governance, we spoke about operators. I think everything needs to tie in. It will take some time. And more important than anything else is liquidity. I mean, if I am investing, then how am I exiting? That is the number one concern. And I think we are, Vimalendra spoke about 5 lakhs versus 1 crore homes in China, right? That is the scale of depth we are talking about. So I think long way to go, but very interesting sectors, and we're already seeing green shoots of capital coming in all these sectors.
Nitin, you didn't want bouncers, but because of shortage of time, I'm going to ask you one. Which sectors do you think we'll see as prominent ones in a decade from now? Beyond residential and commercial, of course.
I mean, if I look at the last 5 years, we've had 5 office REITs, 2 warehousing InvITs, 1 retail REIT, 6 hotel companies, 3 flex space operators, all go public. So, I can't pick one sector. I think some of the other emerging sectors like data centers, warehousing, still at least from a public markets perspective, student living, co-living, senior citizen, all of this I think there is enough scope and more for capital to chase these assets. It's just a question of time and, as Ankur said it, scale. Once they reach a certain amount of scale, that's when you find that the capital that actually can, you need patient capital for all of this, right? Because they pay off in a slightly longer run. And for that patient capital, unfortunately, you don't have small bite sizes. You have large bite sizes. Because it's the sovereign guys, it's the development sort of focused institutions that try and take a bite size early on. And for them, scale becomes really, really important. So its time will come. It's just probably early days.
I think well summarized. I think, sorry, we've taken a little longer than the allocated time. But I hope you've gleaned something from this conversation. So the message is clear. There's a lot of capital. Get your act right. Do the projects properly. Compliance, governance are right up there. And whatever sector you're getting into, bootstrap, get it done, and capital will chase you. With that, I end this discussion.
And
Thank you so much.
on the asset class side, there is only one asset class, real estate. Invest in real estate. That's good for all of us. Put
Nicely
together.
put. Thank you so much. Thank you, everyone. Thank you for listening to us.
Thank you so much. And ladies and gentlemen, with that, if I may request the CEO and founder of Vibrant, Princey Goel, to please join us on stage and allow us an opportunity to thank all our eminent panelists on stage with a token of appreciation. May I request our panelists to please stand up and give us your appreciation with your round of applause, ladies and gentlemen, for all our panelists. Of course, starting with Mr. Amit Goenka. Mr. Goenka, if you can just stand forward and allow us an opportunity to felicitate you. Let's give Mr. Amit Goenka a big, big round of applause. What a fantastic key insights always he presents. Thank you so much, Ankur, for joining us. Let's give him a bigger round of applause. Truly a pleasure having him on the 17th edition of the Realty Plus Conclave. Thank you so much, Nitin. Thank you for joining us. Let's give him a warm, warm round of applause. And thank him for all his valuable and key insights. Mr. Shuvam, thank you so much for joining in. Let's give him a big, big round of applause. We'd also like to humbly thank Mr. Srinivasan. Thank you so much. Let's give him a big round of applause. We'd now like to invite Mr. Vimalendra to please join us at the center stage and allow us an opportunity to express our gratitude to him. And of course, this conversation provided with a session chair. Let's give Mr. Vamshi a bigger round of applause for his key curation and holding the entire conversation with his insights. May we request our panel to please step forward and allow us an opportunity to get them all in one frame. Ladies and gentlemen, let the applause continue. Such great insights from all of them. The top leaders joining us right here on the 17th edition of the Realty Plus Conclave.